Hello, this is Mark from Spanish Property Insight. Today, I thought I'd take a look at the exposure of the Spanish housing market to the rising interest rate situation that's been going on pretty much relentlessly since this time last year. With Eurozone interest rates rising, that means that borrowing costs are on the rise for people with variable rate mortgages. And depending on how high rates rise and how many people have variable rate mortgages tied to those underlying interest rates, and a bunch of other factors that can cause distress for a housing market. So I want to try and get an idea of how much distress there might be in the market given the rising interest rates. Of course, distress for the unlucky borrowers who can't keep up with their mortgage payments due to higher monthly payments caused by the rising interest rates. If they go into default, they could have their houses repossessed, which is bad news for them, but it's also potentially good news for people who are looking to buy, because distress always often leads to opportunities. But really what I want to get a handle on today is just how much distress there might be in the market. And for that, I'm going to look at a bunch of three things, not a bunch of things, three things in particular. First of all, Euribor and interest rates, what's been happening there. Secondly, new mortgage lending by type of interest rate. So does new mortgage lending break down over in recent years between fixed and variable rate mortgages? And thirdly, the look at an international comparison of housing tenures, which means households, in the houses they live, do they live with a mortgage, or are they mortgage free, with a mortgage, or in rental accommodation, and how Spain compares to other countries in the OECD. So that's the plan. Let's start therefore with Euribor. This is a chart showing Euribor, which is the base rate. The 12-month Euribor rate is the rate typically used to calculate mortgage repayments in Spain. Now, this chart looks back at Euribor since the beginning of 2020. And as you can see, up until around March, it was negative, which it didn't mean that people were being paid by the bank to borrow mortgages, but it meant that anyone with a variable rate mortgage had very low monthly payments, because depending on your mortgage conditions, the monthly payments will be Euribor plus whatever the rate that your mortgage conditions apply. And when mortgage Euribor was negative, you have to assume most people, unless they had a very bad mortgage conditions, had low mortgage payments. And then you can see since about, I think it was around December of last year, when it bottomed out at minus 0.5%. Interest rates have risen dramatically on this time scale, on this time span. But I think also, if you look at it, how it's gone through the year, you can see that's from January to November. In November, Euribor was 2.8%. And we don't yet have December. I'm recording this on the 30th of December, so we have to wait a few days to see what Euribor will be by the end of the month, but it looks like it's going to be above 3%. If you look back on a longer time frame, you can see that Euribor has increased dramatically this year, and because of the latest increases, people on a typical Spanish mortgage of, let's say, 120,000 euros with a 20-year repayment plan will be looking at around 200 euros a month on an annually resetting mortgage in monthly mortgage payments. So they'll be paying 200. When their mortgage resets, they will find themselves having to fork out 200 euros a month more than they were a month before. And with the cost of living crisis and a bunch of other factors, that's going to be painful for quite a lot of people, households who are on variable rate mortgages. But it should be said that, or I'd like to point out that these rates are only high by the standard of recent years, and only really since about 2008, because if you go back before then, an interest rate of 2.83% was common. In fact, for the whole period since Euribor since the beginning of the euro introduction back in 2000, rates of much of the time were higher than they are today. So that's just something to bear in mind, that interest rates have risen fast and steeply, but they have not gone up to 15%, which was quite common back in decades before the euro was introduced. So that's what I have to say about Euribor and how it's been rising and pushing up borrowing costs for variable rate mortgages. So the next thing to look at is how do mortgages break down between fixed and variable rates? Because obviously people on a fixed rate, that doesn't affect them. Rising interest rates, when they rise, they don't pay any more each month. By the same token, they don't benefit when rates fall. But let's therefore look at interest rates, mortgage lending, new mortgage lending each month going back to 2009. You can see here, with broken down between fixed and variable rates. Now you can see for most of the time, the variable rate was the norm, with more than 90% all the time, until around 2016, when 2015, you can see that all of a sudden the attractiveness or the interest in variable rates starts declining, and fixed rates go up. And that carries on until about the beginning of 2021, where fixed rates become the majority. So here they are at 52% compared to 48% of variable rates. And throughout this year, new mortgage lending was around 75% of all new mortgages were fixed rate mortgages, people taking advantage of historically low interest rates and locking them in before the interest rate started to rise, which was kind of writing was on the wall, and many people could see that. So this chart shows, and I think if we just go back, if we look at it in more recently here, you can see the same thing, but just a more narrower and shorter time span, how fixed rates have become the norm, which means that increasing interest rates are not a problem for anyone on a fixed rate mortgages, so those people won't be affected. Now, the last thing to look at is the housing tenures and how Spain compares to other countries. So here we have housing tenures from the OECD. This is data from the OECD, and it's data from 2020 or later. So there's a bunch of countries, and not all of them have the up-to-date information. So this is the best picture we can get. And what does this chart show? On the one hand, in the blue columns, we see the percentage of households in these countries in the OECD that are owned outright without a mortgage, with the Romanians we're at, in first position with 95% of households owned outright with no mortgage. Then comes the owner with a mortgage. So these are households for which there is a mortgage, current mortgage to be paid, and they're of course the interesting point here. Then we have private rental, subsidized rental, and other unknown. So where's Spain in all of this? Well, there's Spain right in the middle of the pack, with 49% at this time of households live in a house with no mortgage that they own, and which means only some 20 and only 26%. Where are we? Spain. Only 26% are still paying a mortgage. Now, remember that in recent times, the majority of mortgages new mortgages have been fixed rate mortgages, so meaning that those borrowers are not affected by the rising interest rates. So let's assume that only 20% of households in Spain have a mortgage that is a variable rate mortgage and are affected by rising interest rates. That means that 80% of households are not affected by the rising interest rates. And bear in mind also that the Spanish government has recently forced banks to give breathing room to vulnerable borrowers. And I mean, I don't know what a vulnerable borrower is, but presumably any borrower who is in distress and can't pay back the mortgage. But the banks have agreed to give them some breathing room, and allowing them a longer time spans to pay back, and rolling up the interest payments they're not paying now to be paid later on, and a few things to make it easier and try and avoid a spike in mortgage defaults and foreclosures. Now, of course, that breathing room will not be extended to second home owners, because they are by definition are not really very vulnerable. It's the second home. So anyone with a second home that can't pay back the mortgage is not going to get any breaks from the banks. They have to keep up their payments, and if they can't keep continuing to pay, and they have a variable rate mortgage, and they're in distress brought on by the cost of living crisis and the increase in the monthly mortgage payments, then I guess we could see an increase in the number of repossessions of second. I mean, we're going to see an increase in repossessions in general, but I think it could be skewed towards second homes. So, but in overall terms, these figures are quite encouraging, because Spain doesn't look particularly exposed. The Spanish housing market doesn't look overexposed. There will be, like I said, around 20% of households with a variable rate mortgage, and that could cause problems for the housing market in 2023. But compared to other countries, Spain doesn't look too badly placed. So who is badly placed? Well, let's arrange the table by owner with mortgage and see how that affects the chart. So here we see, well, the Norwegians have the highest percentage of households with current mortgages to pay. But the Norwegians, there's not a country, they're not short of cash, and they're not in the Eurozone. So I don't know, I would expect they'll be able to manage that. And the Netherlands as well, Iceland, Sweden, so those are all Northern Europeans and Nordic countries, where what I don't know here is what percentage of mortgages in those countries are fixed rate, which would not be a problem in an environment of rising interest rates. So, but if there's a correlation between countries with households with outstanding mortgages and rising interest rates across the world, then these countries with the bigger green bars are going to be the ones that feel it the most. And like we said before, Spain is, where are we now? Where is Spain? Is here. It's not particularly exposed. It's not the best, but it's not the worst. So hopefully that means that there will be a calm, distress-free year for the Spanish housing market in 2023. But there are a bunch of other headwinds which I'm not going to discuss right now, but which I will try and cover in a video soon, early in the new year, which headwinds which will be buffeting the Spanish housing market. But interest rate increases is one of them, but hopefully from this picture that I've painted, not the worst. Anyway, thank you for tuning in.